So you guys who watched grew up watching Saturday morning cartoons, now you have Saturday morning Holy Macro Show. So Saturday morning cartoons were probably terrible for your brain if you really think about it. Growing up and just doing that to your brain every single Saturday morning, but I sure as hell did it, and I really enjoyed it. But I figured this is much better, so this will be good for everybody's brain. We can talk about the markets, we can talk about what's going on, and this year, or sorry, last year now. So 2025 was a hell of a year. We bought a lot of these mining stocks. The shop had probably some really wild ones. So some of those returns were probably insane. And then moving forward, now it's what do we do next year? We have the first year, which is great, but next year is always important. It's a little. I guess you guys can see this full thing. I can't because of some of the notifications on StreamYard. But this is a Phil Jackson quote, and I always think about this every time I have a good year. Everybody knows that's something that I always think about, and I've been talking about for the last 6-7 years, which is if you have these great returns, that's great, but what do you do next year? And Phil Jackson had this quote, and it was in Last Dance, and this came out in 2020, and he said, "You are only a success at the moment you perform a successful act. You have to do it again." And I always bring this quote back up every single year at the end of the year because it's like, number one, all the positions are wiped. So if you follow me, we're not going to be running into next year going like, oh, look at this really great return we had last year and how this is carrying over into this year. There's tons of people who do that. I bought this stock. Now it's up 1,000%. Like, yeah, you've been holding that shit on forever. Of course it's up 1,000%. Or maybe you don't even have it at all in your portfolio. And you're just talking about it because you recommended it to your subscribers years ago. That's not what I do. I'm a trader. And as a trader, I'm going to put on those positions, and I'm going to know that at the end of the year, that's how I get paid. I get paid in, okay, we made this much. This is how much I owe in taxes, all these things. And then we move into the next year, starting back at zero, once again, for all these positions. Fresh start. You don't make money by going, hey, last year we did really well. You make money by going, okay, this year we're going to do well again. So once again, it's not the fact like last year's an interesting one because 2025, I don't expect to see returns like that every year. People always think like, hey, I could do better and I could do better and I can do better. It took me 2021, I had 179% return. This year we topped that just barely. These are returns that don't happen all the time, and the market environment has to be very conducive to do that. So, when you get those types of opportunities, you really want to push your foot down on the gas pedal and really go for it and make that big return because you don't know when you're going to have that opportunity again. Now, we have good returns year after year. We have a really high CAGR. We've outperformed the S&P 500 for the last 9 years now. So as long as that's happening, I'm really happy. But some of these years, we're going to have those huge outlier trades that are going to move in a big way. But I don't want to get wed to that and say, I'm the best trader ever. I had this really great year. I want to understand the fact that having one great year doesn't do shit for me. Like being able to be consistent, have consistent profitability. Even those return years where it's like, okay, it's 2022, we're putting up around a 30% return in a year where the market's down 20. That's a great return still. And understanding like I don't need to beat myself up about that because I'm not hitting 180% every single year. You have to know the market environment and what you're getting. Some years are going to be better than others. We really had a good year this year, so I'm really happy about that. And moving forward, we'll see where we go. Kashop, I want to ask you, you've bought all of these mining stocks. Name a couple of those that you bought for your research channel that basically had crazy performance. I'm sure you have a few.
Sure. So, yeah, and there are many actually. So, 1911 Gold, that was the best performer. That at one point it was a brief 10 bagger, and after that, I think now it's a 6 or 7 bagger. And then one of the trades that I closed, probably maybe a little early, but it was for the right reasons, was IM Gold. I booked a 264% gain on that stock. I exited a little early, should have still held on, but then hindsight is 2020, right? Then another stock I had good gains on is Integra Resources. 80% I took it off the table, and it's not like I've taken a lot off the table. I currently have around 20 plus stocks. All of them are up over 100%. Some of them are up 400, 500%. And my biggest winner, like I said, is it's not a gold stock, it's a rare earth stock, which has contributed 11 percentage points to my overall portfolio, the PNL. So I had these big winners. And to be honest, congrats on your big year. But for me, honestly, the year was not that great. I had a 34% up year on the portfolio, and that's because I came into the year with around 40% allocated to the gold space. So the explorers, the small caps, the juniors for the most part. But the other 60% has been kind of sucky. So I had big trades in the oil sector, which went absolutely nowhere. Then I had trades in dry bulk, which dry bulk shipping space, which again went nowhere. I had decent performance with the oil tanker stocks, which is right around the same performance as my portfolio. And then I had some big winners in the luxury sector, but in the 50-60% range or 50 to 70% range. And I had some big hits all as well. So early in the year, from Jan to April, that was terrible. So I made a lot of picks which just did not perform as well when we had that flash crash. And then by April, I had to reevaluate. But then it all worked out. So overall, I think it's the volatility of the year was such that we look back and say, yeah, it was obvious. But had you taken a pause sometime in April or sometime in, let's say, September, it was not that obvious. And after that, the trends just took off, and that's where I made my return. So overall, I'm quite pleased with it. But given the year gold has had, I am kind of beating myself up a bit as well, because I know I could have done better. But then hindsight is 2020, right? So hopefully this year I will do better.
It's always easy to say at the end, and it's also the positioning. I always talk about the fact that as a trader, it's not only like how well you're doing or your performance, it's also how you positioned. Coming into this year, if you're positioned in these areas that you would think should take off, the way I trade it is a little different, where it's like, okay, I'm taking strength, I'm buying strength, I'm buying strength, I'm buying strength. That's what I basically do. But if you come into it and you're doing the opposite thing, sometimes these things lag, right? So coming into this year, it's like if you're in the energy space in certain names, you're in dry bulk shipping. These areas should be the major outperformer coming into this year. So I think you're positioned well any way you look at it. And also, it's good you said that about, once again, it's not like we can always look back and say like, hey, trading should be better. But really, it's like, am I outperforming the S&P 500? Am I doing the job I should be doing? And am I positioned for the next year going forward? And that's the truth. Like, and so as long as you're doing that, I think you'll do well. So this question came up. How is your Latin America position going to do now? This is so dire. You know what? I actually closed all my international positions on Friday. I'm done with all of it because I heard about the Venezuela thing. No, I didn't. I didn't do that. That's a joke. I would never do that. Number one, there will always be news flow. There will always be wars. There will always be things that are happening. You don't know how they will affect the market. Some people think war is always this thing. Like you have a war, war breaks out. Obviously, oil must go up. War stops. Obviously, oil must go down. And really, it's like, yeah, in short-term periods of time, sure. Like it could open up Sunday and people could panic. It would be kind of ridiculous for them to panic about this situation, as it's really going to affect oil and gasoline prices very quickly. It would take a long time. We'd have to change our refining centers in the United States to even really take Venezuelan oil to that level. So there's a lot of reasons why that's really not a big thing. Also, go look inside the Latin America ETF or anything. Do we have many Venezuelan stocks in there? It's another thing to take into consideration. No. Do we think Donald Trump's going to do that to all of South America? That would be really hard to do. There would be a lot of people that would be very pissed off. Like, let's say we went after Brazil. That wouldn't be a situation that would be okay with the rest of the global economy. That would be a problem, a huge fucking problem. That'd be something that would change the shape of the world and the geopolitical landscape, and also would create probably World War III very quickly. So he can take out Venezuela. That's I'm not very. not great with taking out other countries for different reasons. But at the same time, it's like that's looking at it just from a market dynamic. This is an aspect of it that I think isn't too crazy. I don't think it really affects anything going forward in a big way. But I think it is saying that resources are scarce globally. And, something I want to talk to Shop about that I can pitch off of you for a sec, Shop, which is I'm looking at China. Did you see China and the rare earths thing recently? Precious metals and rare earths.
I saw the silver news. They are going to stop the exports. Yeah.
Yeah, they're going to stop the exports. They're also talking about doing it on rare earths and just about everything. So, to me, this is a situation of looking at it more as like, is this a global currency war? Global commodity war kind of starting, where it's like, once again, like think of 2000. We were right on in the midst of that huge run that happened. 2001 happens. We start to go into Iraq. We do different things. We have Afghanistan. We end up all over the Middle East. We control different areas. We definitely know today, like a lot of that war was about oil. People can have their own opinions on that. Feel free to. But for me, I see a lot of that was about oil. And then going forwards, it's like now we're seeing like governments are investing straight into rare earth companies and precious and metals companies and so on. So we're kind of seeing this interesting commodity war thing kind of come up today. And now we just went into a country and took their president, and now we're putting him on trial. So it's like we kind of had this interesting commodity war thing happening here. And it's going after metals this time instead of oil, which I'm assuming at some point oil will probably be a part of that story as well. But, I'm just speculating here. You might know a little bit more about this than I do. Do you have any thoughts on this, Kashab?
So I think the entire posturing, it's all around oil. And if you go back to the reason I'm saying this, if you go back to what's the spat between Guyana and Venezuela before this happened. So there was a few years back, there was a big oil discovery offshore Guyana. And Venezuela kind of said, hey, that's our territory. We are going to hold elections there. We are going to seize this oil. And the oil right now belongs to Chevron and ExxonMobil, which are two of the most powerful companies on the planet. So they probably tapped President Trump's shoulder and said, hey, you have to protect our interests, which is where all this happened. So I think the entire world is now looking at this and going, we have to protect our resources. And whoever has the resources is the golden rule, right? He who has the gold makes the rules. So China has all the resources, Russia has the resources, Indonesia has the nickel. So everyone is now like, this is a strategic commodity, or this is something that is strategic to our country. We cannot just let whoever mines it or whoever process it export it just like that. No, we need to have a say in it. It's of national importance. So when this comes about, then you start prioritizing sales to your allies first, or sales to countries where you expect a quid pro quo in return. And then once you get down that path, then other countries will also be forced down that path. And that's the end of free trade. So once you see the end of free trade happening, then you're seeing deglobalization happening. And then what does that lead to? Well, that leads to stagflation because supply chains are no longer efficient. So you're dialing back 30 years of progress or 40 years of progress. So where does that lead to? Simple answer, it leads to higher prices for everyone. It leads to a reduced cost of living. It makes it much more difficult for the middle class to move up in their lifestyle. So I think we're going to be seeing all of that. Probably not this year, probably not next year, but that's a trend in motion that cannot be stopped. And I don't think it's going to be stopped until we get to some major event, major geopolitical event.
Yeah, I agree. I think it's just we're at this point in history really where it's like, hey, we've known there's been resource issues for years. Like there's been a lot of like speculation of things that were at the time a lot of bullshit, things like peak oil theory, things like resource theory. Like there's been a bunch of theories that we're running out of resources out there. And going forward now, like it seems like we're getting closer to these times. Doesn't mean that, I think we're really running out anytime soon, but it seems like governments know something somewhere and they're going after things. The peak oil guys would come out and talk about that was the reason we went into Iraq. I don't think that's it, but we wanted to control the oil. That's also another thing. So now it's like, well, we really like think of semiconductors. They run the world. You need silver, gold, you need precious metals, you need other rare earths to create these things. Every phone in your hand, every computer you have, like every car, it has all of these metals in it. And now we're kind of at a point where we need them. And there's no way to really exist in our society without them and keep everybody basically consuming and obeying the global structure at this point. So if we kind of see that the writing on the wall for this, I think this is something that's going to continue, and we'll see more of it going into the next year. I think that leads to a major, I mean, that reminds me a lot of the 70s. That's a major stagflationary idea here, where it's like, hey, we might not have the ability to create growth or all these things, but we will create the ability to get more of these commodities out of the ground and create more of this commodity cycle and a big boom in the commodity cycle. So I think it's we're running the right way through the cycle. Precious metals start to move, great. Then we see the industrial metals. Copper had a great year. I think it was his best year since 2009. So I think that's going to continue as we move forward through this process. So we do have a question here that I wanted to answer from Free Lee. So says, I find myself wanting to get in every trade from Substack and Gold Rush. Is there such a thing as having too many trades, or opposite? Is there such a thing as sitting on too much cash, basically? So quickly, my quick answer on this is yes. It's the size of your account that really matters, right? So if you have like let's say $1,000 account, you're not going to have like 50 trades in there. Doesn't really make sense, right? That everybody probably gets that. But if you have like, a $10,000 account, you might have, 1,000, let's say you have 5 trades, really. Maybe 10 would be a possibility, but that would be probably a lot. So let's say 5. You go to $10,000, maybe you have more like, 15 trades. Then you get to 100,000, maybe you can have a little bit more, maybe around the same number even. But once you get to those really big numbers, if like you see, a lot of people will see me on the account, like I'm running a fund. I've also been doing this for a long time, so the money's been put away for many, many years. So you build up that size over time, and then I can trade the amount that I do in different accounts too. Like when I really list the different accounts, I am saying like there is a long-term portfolio which really doesn't have any leverage in it. There is a futures and options portfolio which does have a lot of leverage in it, and then there's swing trading portfolio, which is just primarily stocks we're swing trading. So I split the money into different areas. I run different portfolios. So definitely always look at what you're doing, and also put a cap on it. At first, like you probably want to be like, okay, I can only have 20 trades at most. It's everybody wants to take every trade, right? Like it's a thing, but at the same time, is it the way to make money? Probably not. Go ahead, Kashap. I'm sure you have a thought on this too.
Yeah, so I would say this is all very. It's about knowing yourself. So there was a time when just one example. So there was a time when I was running a long short portfolio with heavy leverage, and I had around 80 to 100 trades on there. There was a time when I was working as an analyst and I didn't even call myself a trader. I called myself an investor. I had maybe 20 value stocks in the portfolio, and that's it. So it's about what you look at as your strategy. So are you an investor? Well, if you're an investor, then what time frame? Are you trading the 6-month, 8-month time frame and calling yourself an investor? Well, then you are a trader. Are you doing 12 plus months or a longer term holding period and you're calling yourself an investor? Then yes, then if you take in every long-term trade that you're looking at, then you're probably doing fine. And especially if you have a monthly income coming in and then you have savings to deploy every month, then you're just taking whatever is the best trade that you found that month. Well, then it makes sense that your portfolio gets bloated. But the flip side of it is, now go forward a year, and what happens? Most of these trades run their course. So then suddenly now you are sitting on more cash. So there's a rhythm to this, which naturally will get solved over time based on what you're looking for. So you don't really have to take a snapshot at say Jan 1st or Jan 2nd and say, do I have too many trades on? Because if you define your strategy right, define what your process is, then the number of stocks you own and the cash level that you find yourself holding, those will all just take care of themselves. So, meaning these are the derivatives, these are not the principal things that you need to be focusing on.
No, I agree with that. So moving on, if we have any more questions, feel free to drop them. Another one from Tom: how to decide the weights of the different assets in each portfolio. It's all based on volatility. You know, you take, like, if you're have a swing trading portfolio and you're like, okay, well, these positions need to be like 3%, let's say, because I have a bunch of gold mining stocks because they're very volatile. They might be 3% in that portfolio. And then if it's something like a bond, that could be maybe 10% in a portfolio. It all just depends on that. That doesn't change per portfolio. All the portfolios for me are weighted in the exact same way, which is all based on volatility. I think that also answers your other question freely. But it's continue to do that, and you're going to make money over time. So this is a chart I wanted to bring up, Kashop, is gold versus the S&P 500. You know, there's so much speculation about this, which is funny. You know, I remember I made a post. It would have been all the way back beginning of this year, this little breakout here that happened. So when that little breakout happened, I've said, you know, hey, buy gold, you know, like, and people were like, wow, you know, you trying to sound like a contrarian when you're telling people to buy gold as it's already in the massive uptrend. I think it was probably 2,800 at that time. And I was like, no, I'm just saying, like, this is relative strength is saying you want to buy gold over stocks at the moment. That's all. At the very least, growth stocks and tech stocks. And so that continued to move up. We had that little sell-off. Everybody said, oh, that was over. But really, to me, it just reminded me of this, the beginning of a move, not the end. We did get that bottom out process. Now we're moving back up. We haven't seen that massive breakout yet. But I want to ask you, what are the implications you see here? You know, do we think the gold's going to be flat and the S&P down, both down, gold less than the S&P 500, or do we think gold just continues to outperform the S&P 500 and the S&P 500 is probably flat to down?
I think gold continues higher. The S&P 7 plus the other 493 tail stocks continue to go down, and the index gets rebalanced at some point to make it a little more palatable for investors, and then we see gold outperform the S&P 500, the real 500, and not this fake economy that we are in right now where it's all just circular deals between 2 or 3 companies lifting up the index. So I think we are going to see gold go much higher, and we are also going to see liquidity shift. We are going to see the hedge funds and the family offices and all these institutional allocators, they are going to actively take their money out of the S&P 500 and related products and put it into gold and related products and into other commodities. And the reason we are going to see this shift is because it has become so obvious to everyone right now that, so going back a year, if we had told people, and we did tell people, that the dollar is going to enter a downtrend, everyone said, no way, Trump is president, so of course the dollar is going to go up. And what happened? So the dollar went down. So I think what we are going to see is people are going to see, yes, the dollar is going to go down. It's in a structural downtrend. The S&P is completely out of whack. This AI trade is all circular financing. There's no way this should be legal, and there's no way that the retirement savings of so many people should be invested in just 7 stocks, which is quite ridiculous. So when that shift happens, I think we are going to see allocators actively front run that shift and move their capital out of the US stock market into all these other products. So it's going to be great for active investors. And if you go back to, say, 2024, the early days of 2024, the only trade that was working was AI, not gold, not silver, not palladium, platinum, nothing worked, not even copper. The only trade that worked was AI. And then we saw a shift where AI still worked, but the other things did better. And now we are going to see that trend accelerate and probably go parabolic. So I don't know, but it's a great time to be a commodity bull and to be bearish on stocks in general.
Yeah, I think it's interesting. I don't know if it's for me. I don't know if I'm exactly bearish on. I mean, I think bearish on stocks. What you're saying too is probably the big stocks that are really driving the index returns
Yeah,
are probably
right.
not going to perform. And then these other stocks in these other areas probably will do well, but they're not. None of them are big enough or a big enough weighting in the S&P 500 to do anything for the S&P 500. So it's a rotation out of these, names that have been winning for so long into these other names. Now, I'm not for myself. I'm not saying like, hey, Amazon, Apple, all these things. I don't own any of them. I don't really want any of them. I don't think it makes sense right now at all. But at the same time, I'm not saying they're going to go down. And if your retirement's all in these things, you want to hold it for 40 years, great. Not the way I do things, but great for you. But really, I think there's a lot better trades out there and a lot better places you're going to want to be if you're a trader in this market. And what, the bond market is saying today, it's speaking loudly. There's a couple different charts I want to get to on the bond market. That was one. Did I bring the other? Of course I didn't bring the other. But the Fed rate continues to move lower. 30-year rate continues to move higher. It's hard to see on this chart. It's a very long-term monthly chart, but as you see, like the Fed is lowering rates here, basically starting at this point. And then the 30 years just continued to trend higher the whole time. We haven't seen a new breakout level, but we get closer and closer. And if you look at German yields, the bonds, they're basically continuing to be in a strong uptrend. If you look at Japan, ridiculous uptrend, parabolic, if you want to call it that. If you move to, globally, like all the yields look pretty similarly, and we're just kind of chopping around waiting to make this new high here. So I do think we're going to see it. I do think this is the year we see bond yields start to move higher. And the environment that gold likes best is when we see it just chopping around. When you see bond yields just kind of chopping around, inflation a little bit sticky, it's a great environment for gold. And then this uptrend, it depends on how strong inflation is, but most of the time this uptrend starts to put a little bit of pressure on those markets. At the moment, the under the surface inflation, what people are seeing, and not to mention central bank buying and FOMO into these markets, is committing more people to gold and silver than anything else at the moment. I think this is going to broaden out as we get up here, and we'll start to see things like energy and other things catch a bid. But really, for me right now, it's the base metals. I think that's the next trade. Sam had a great post the other day that was just all it said was, you missed the precious metals rally. Don't worry, the base metals rally is probably coming too. And really, it's like above this level, I think that thing's going to get out of control. Now, copper miners have already been a little bit out of control, but I think that's where we start to see the aluminum stocks, the steel stocks start to go really crazy and have huge moves. And then we probably start to move into those energy stocks and other names that you have in your portfolio, like dry bulk shipping and so on, will probably do really well in that environment. So what do you think about bonds here, Kashaf? Do you think we're in an area where the Fed's going to come in and do an operation twist or any of these things are even possible at this point? The amount of money you'd need to really move the bond market anymore seems so insane that I don't even know what they can do. But I want to hear your thoughts on that one.
Sure. So I think bonds right now, especially the long-term bonds, they are all certificates of confiscation. You should avoid them like the plague. So as for what the Fed will do or what the Treasury will do, so you saw last year the Treasury started to buy back its bonds, meaning they were issuing new debt to buy back the old debt. And the reason they were doing that is because of yield curve mechanics, which I won't go into detail. But what happens is when they buy a bond which has a 28 or 27 years to maturity and they issue a bond which has 20 years to maturity, they kind of soften the yield curve dynamics and make it more profitable for the holders of the bonds. And they did this because, well, for the mostly to keep yields from spiking more than they already have. And they also did this to save the banks. So the banks, the unrealized mark-to-market losses on their bond holdings hasn't really gone away. So if you go back 2 years now, it's been 2 years. Wow. So we had this crisis with the First Republic Bank, the Silicon Valley Bank, Silvergate, Signature, and then Credit Suisse. So you had all these banks pretty much go under. and the Fed was still hiking. They said they were tightening, but then they started doing all these emergency programs, and the goal was twofold. One is to save the banking system, and the second is to save the bond market. And then investors kind of forgot about these problems because, the AI, the shiny new thing, captured everyone's attention. And now AI is kind of done. Investors are back to focusing on the bond market. So when I log into Twitter to see Happy New Year messages, I see emergency liquidity injection into the banking system, highest overnight repo in history, sensationalist news like this. And that's all because one, it's year end window dressing for the banks, and two, because something is really cracking in the bond market and it's getting apparent. So I don't know if the Fed will outright do an operation twist, meaning they buy more of these long-term debt and sell more of their short-term uh, the short-term treasuries that they hold in order to kind of balance out the assets that they have. I don't know if they'll do that or they'll just straight out start their QE. I mean, they've already started their QE, but right now it's at 40 billion a month, and they said they'll taper to 25. Maybe they just keep going to 40, 50, 60, and then invent new programs, new of balance sheet expansion. And they do all this just to make sure that yields probably top out at 5% and not 10%, because 5% is still manageable because everyone is used to deficits rising at $2 trillion a year. But what if deficits start to rise at $3 or $5 trillion a year? Well, then it becomes more alarming. And there is some point at which it's a tipping point. It's like the proverbial straw that broke the camel's back. So when you have a $2 trillion deficit, right now market's like, yeah, fine, it's a 2 trillion deficit. And then you become 3 trillion and market is still like, yeah, fine. And then something snaps and the deficit becomes too big a problem, bond yields go crazy, and then you're in a Argentina like situation or a Brazil like situation where people just want to completely avoid the market. And then what can the Fed do? Well, at that point the currency just collapses. That's what happens. So collapses meaning not like it goes to zero, but it loses value so rapidly that people hold any and all assets in order to save some of their purchasing power. So you get into a situation like that, no telling what will happen. So the Fed will be forced to do a lot of measures in order to prevent yields from spiking. And that's why when I say I'm bearish on stocks, I wouldn't necessarily say you have to go short stocks today. And that's because the Fed is printing money and they're going to keep printing money and they're going to accelerate the pace of their money printing. So shorting is really not going to work, I think. But if you are in the assets that benefits from the Fed money printing and all the other macro dynamics that are happening now, then you're going to be a happy camper and you're going to do way better than the guys holding the S&P 7 plus 493, the Max 7, all these guys.
Yeah, I think that's the biggest thing. Like, I think at the end of the day, it's like there's all this stuff. Like, we could speculate on what exactly the AI trade is and all this shit. But at the end of the day, it's like just look for the things that are going to outperform the most. Like people keep talking about, oh, technology did good this year. It's like, yes, if you only look at the spider sectors like an idiot, like that's absolutely fucking ridiculous. If you look at gold miners, like they were up I don't even know what they closed the year at, but let's say 180% for GDXJ. We're looking at some of these names were up, 400, 500 to 1,000% pretty easily. You're also looking at the metals and mining sector being up around 80% for the year. Copper miners had a great year. Lithium stocks had a good year. Solar stocks even started to do well towards the end of the year. You're looking at all of these like different commodity-based, metals-based sectors starting to pick up. Steel stocks did very well. Aluminum stocks did very well. So, for me, it's continue to look for what is outperforming, continue to be in those sectors. Energy is not outperforming yet. That's the reason why, I'm not too crazy bullish on it yet. But I think what we're going to see this year is coming. Like, for me, this is the make or break period for energy. Either we're here and we start to see energy make a big move at the beginning of this year. Not today, not tomorrow, but over the next 4 months is what I'm looking at. It's a very good seasonal period. I don't like seasonality as a trading tool, but I like to look at it as, okay, this should happen. If this doesn't happen, something is happening otherwise. Like, for example, if you see the S&P 500 having a great summer, for example, That's very rare. When it usually has a great summer, that move usually continues through the fall, the winter, and so on. Same with gold miners when they really buck that seasonal pattern where they get those sell-offs in mid-August all the way to October. You usually know that gold miners are probably going to just rip into year end, which they did. Now looking at this, I'm just thinking energy should follow that seasonal pattern. We'll just keep watching that. European bank stocks had a very good year. I am so happy somebody brought this up. Do you think this will continue? Absolutely. One is the environment. The environment here is an inflationary environment with the yield curve steepening. So when you're in a bull steepener, we're basically looking at the long end of the curve. Well, actually, I think I did bring a chart of a steepener. So we're looking at, so this is a steepener here. This is a bear flattener. This is a bull steepener. So bull steepener basically means the 3-month rate is lowering faster than the 10-year rate. So the Fed is lowering rates. That's really attached to the 3-month bonds more than anything else. So as they're going down there, the 10-year is moving higher, or the 30-year, as we just saw on this chart. So 30-year is moving higher, at least holding that same zone, while the short-term rates are lower. The banks borrow from the short-term part of the curve, so the 3-month part of the curve, and then they lend to people from the 10s and 30s, mainly the 30s, mortgage rates and so on. So as they're giving people these long-term rates, you're basically seeing they're making that middle point between the 3-month and the 10-year. So, for example, this is just an easy way to put it. This isn't where rates are today, but the easiest way to say it, when we had rates at 0%, the banks are getting, 25 basis point loans, which is very cheap. They're lending it out at that point. It was a 3% rate back then. So they're basically giving that 3% rate to normal people. So they're paying 3% back, more than that, honestly. But let's say just 3% back. And then they're loaning at that 25 basis points. So they're making that middle between that, which is a lot of fucking money. And so this creates more liquidity in the market, which is why you see commodities tend to move with it. So at the moment right now, if this was weighted more in gold, these industrial metals, we'd see this thing in a massive uptrend. This is mainly weighted in energy. And so I think the energy trade's definitely coming here as we move into 2026. Once again, it's a continue to wait and see. I'm not making a call and saying I'm going to buy all these things. I'm saying pay attention to it. The energy trade could take off, but for now, on those industrial metals, that's a great place to be. Continue to hang on to those gold miners because we don't know where that's going to end up. But I think at some point you want this on your radar just to get an understanding of it. Kashab, so what are you thinking about that?
Yeah, so just to jump in on the European bank stocks question. So I want to go back a little on that. So if you look at what happened after 2008, all the capital pretty much came out of Europe and flooded into the US dollar because the USD was a safe haven currency. And then we had the 2011 Eurozone crisis. And once again, it was the same trade. So capital flowed from Europe into the US. And this has been going on for a really, really long time. And this has started to reverse. So now we are seeing capital move out of the US and back into Europe. So when capital moves, well, that's great for the banks. And the other thing you have to look at is who is banking Africa? Who is banking South America? Well, it's the European banks. It's not the US banks as much. So when you're seeing all the other economies, the so-called emerging markets, the Latin American markets, all the other parts of the world, the rest of the world, when you're seeing the rest of the world start to outperform, now, whenever a country starts to do really well in terms of its economy, in terms of its growth, what happens is the banks do really well. That's why if you look at a country like India, bank stocks hit all-time high after all-time highs on a daily basis, and it's not even news anymore. And the reason is because the economy is growing. So in this situation, you can see European banks absolutely kill it. So, and that's a trend that can last for a really, really long time. And that's because it's reversing a trend that was in place for a really, really long time. So I absolutely think European bank stocks can continue to do very well. I wouldn't comment on any particular stock. Like if you're going to ask me about HSBC or Deutsche Bank, what will they do? I really don't know. I don't know what their exposure is. I don't know who their counterparties are. But broadly, as a category, I would say the banks will continue to do well.
Yeah, I agree. I think it's the environment we're in is just perfect for it. You know, when you have a global reflationary environment, especially Europe, if you're looking at even some of Asia, Latin America, all these banks look amazing. I think it's something to continue to be long for a little while. Probably a great place to be coming into 2026 for sure. The European banks, some of them run a lot, so be careful with that. But at the same time, it's you don't want to hop in front of a freight train, and that's what I think is important here. So let's do our best not to do that. So next chart, we have the dollar index, and the yield curve, and this also shows you that we're also in an environment for the dollar to continue to get weaker. I don't see a scenario here where we're going to see this thing all of a sudden just turn back up here unless the Fed does something very different. If the Fed came out today and said, hey, we're going to start raising rates, I think the dollar would get very strong. The probability of them coming out and saying they're raising rates is fucking astronomical. I would be floored if they came out and said, we're going to raise rates. So nobody panic on that and think I'm actually saying that's a possibility. I would be very surprised. But I think the dollar is just going to continue to move lower going forward into this year unless something fundamentally changes. I'm still have the same target of about 90 for the dollar index. We'll see where that ends up. But what are you thinking about the dollar this year, Kashaf? Do you think it's somewhere where people should continue to position the same way we've been because the dollar should be weak? And what is the catalyst for you that the dollar would possibly get strong once again?
So I agree with you on the strong dollar catalyst, and that's the Fed hiking rates. I don't see anything else, anything Trump does on the geopolitics side. Any of those, I don't see it as bullish for the dollar. In fact, you add tariffs, that's even more bearish for the dollar. You add a new war, that's also more bearish for the dollar. So, other than a surprise rate hike and posturing around continued rate hikes and quantitative tightening, if they say we are going to shrink the balance sheet, if the Fed says they are going to shrink the balance sheet back to where it was in 2008, say 700, $800 billion, and they are going to unleash a massive deflationary wave on the world, then yes, the dollar is going to get really, really strong and you should own it. But other than that kind of scenario, which I mean, it sounds silly to even talk about it, other than those kind of scenarios, I can't see the dollar getting stronger. And so, if the base case is that the dollar weakens, what do you do? Well, last year, which was the first year of this trend, which was actually tradable, I went long Swiss francs, euros, pounds, a basket of the strong currencies. And this year, I would say be a little more brave. Go by the Brazilian real, the Chilean peso, the South African rand, all these other currencies, size it so that you're not killed if something goes wrong in just one economy. And I think if you buy a basket of these currencies, you will do very well, because it's been a long time since we have seen the frontier markets or even the Latin American markets do well against the dollar. Their currencies do well against the dollar, but I think that time is coming. Argentina is particularly interesting because US kind of loves Argentina right now, and they're going to have closer ties, which means you're going to see less stress on the banking system there. And Javier Milei, a so-called self-described anarcho-capitalist, I don't know if he is really, but if he does away with the currency controls and free floats it, and inflows start coming in, and the oil in the Falklands, all the shale gas that they have, all of that starts getting tapped, then, well, that's a resource powerhouse and it's going to strengthen the currency. So you have interesting situations like this developing, and Bolivia's another situation where they are kind of pivoting from left to right, or at least left to center. So if that happens, then you're probably going to be looking at opportunities there. So I don't know how it plays out, but I think this is the year to be bold in terms of taking currency risk in the markets you wouldn't have dared to take currency risk in.
Yeah, that's a good point, because I think it's the Latin American currencies are very interesting here. Basically, any emerging market currency that we don't normally see or people don't talk about. Peso's been a hell of a trade too. Like there's a lot of them if you look down the whole list, that's like, this is where I want to be. European currencies have been outperforming. A lot of people don't trade currencies in the United States, which is a damn shame. You have so much leverage you can use on these things. Like, yes, if you see the dollar move 1%, you're like, who gives a shit? The leverage you can use in the Forex markets is absolutely insane. And so getting a good feel of these currency markets and as another diversifying way to make money as a trader, I think it's really important to understand it. But just looking at what Kashap said, like, there's opportunities right here, right now that we haven't seen in many years. And so I think you should really open your mind to the currency markets quite a bit. And this is, we don't need to go over this for very long, but just for just a moment, gold is just trouncing everything at this point. Like, this is a insane rally. Stocks are doing okay against commodities. And once again, this is mainly an energy-based index. So mainly against energy. But if you go all the way down to the bonds haven't gone anywhere against commodities. Everybody's like, oh, commodities are shit, but they want to buy bonds all the time. They're like, oh, I'm going to buy TLT and calls on TLT and all this shit about TLT all the time. But then you look at the bond market and you're like, wait, this looks like shit. But at the same time, if you look at commodities, they're like, I don't want to own any of those. And it's like, some of them have been performing insanely well. Some of our best trades this year have come from the commodities market. But once again, everybody just looks at oil and they basically go, okay, everything else is null and void. Who gives a shit about the rest of the commodities market? And really, like, bonds are this safe haven that you've been told for your entire life that you need to buy these damn things and put them away in your retirement, and you're going to be rich when you're 90 years old and about to die, basically. So I really don't like the idea of owning bonds here still. I think we need to move past this. Kashap, though, silver. I even told Kashap when we got on, I said, I don't even want to talk about silver anymore. I'm so done talking about silver at this point. I feel like I've been talking about it till I'm blue in the face. We talked about it for the last couple years, basically, talking about the fact of, we should see silver outperform gold at some point. Gold was started to move. It was 2024 really when it really took off. Silver just kind of chopped. I mean, for me, it was doing fine, but everybody was like, well, why isn't it doing better? Why isn't it doing better? And I would say the same thing is it will at some point. It has a tendency of always catching right up to gold. So it's going to move. And then it just chopped around a while here. And we got a little bit of a move, more chop around where everybody was like, oh my gosh, this is over. And then it just goes insane. So Kashap, what's your thoughts on silver? Do you think this move is sustainable? I know there's a lot of stuff kind of going on in the background currently. If we're looking at China, if we're looking at basically the structure of the silver market, if we're looking at the ability to even fulfill futures orders to give people the physical product. So what are you seeing here in the silver market? Do you think this is sustainable?
I think it's sustainable. And the reason for it is everyone looks at the chart and says, oh, it's gone parabolic. Yeah, it's gone parabolic. It's an uptrend. You do not see parabolic moves, parabolic up moves in a downtrend. You see them in an uptrend. Now, the question is, are we early in the uptrend, which means you should buy into this parabolic move, or is this the top? That's really the question people are asking when they say, hey, this has gone parabolic. Is it still a good buy? And for that, well, it depends on your time frame. If you're going to buy physical silver and store it and pass it on to the next generation, which is what Indians do, well, yes, absolutely, it's a great time. If you're going to trade it around, then I would say a volatile product like this, you're taking a lot of risk trading it around. But if you're buying something which is related to silver, like let's say the silver juniors or the silver producers, the silver miners, something like that, well, then absolutely it's a great time to be in it. And the reason I would say take exposure into these companies rather than the metal is because there is a lot going on with the metal and we are not sure which part is rumor, which part is fact. So you're going to get a lot of news coming out on it on X saying some central bank is standing for silver deliveries and that's why this is happening, or China's banning silver exports, that's why this is happening, or the big bullion banks are short 1 billion tons of silver or some other number and that's why this is happening. And any of those might be true, all of it might be true, we don't really know. But if you're buying companies, well, then you have a basis on which to evaluate them. And that makes it very easy for you to decide whether or not you should allocate capital to that space right now. So I would say if you're buying physical with the intention of passing it on or holding it for a generation, holding it for 10 years, something like that, it's still a great time to buy it. But if you're buying it for a shorter time frame, then focus on the companies rather than just the metal.
Yeah, I totally agree with that. And then that kind of answers that one question we had about silver miners. Do we think silver miners are, let's see here, silver miners front ran this move in the underlying, or is there more room for them to run? And so for me, I think that it's like, one, it's, you see these physical products make big moves, but also you have to know the underlying stocks, or sorry, not even the underlying, but the stocks will start to move with it as well. But it's always going to be a little bit delayed. It's not going to show up in their earnings immediately. It's not going to be something that's on everybody's radar. Sometimes they run, people front run the move, but sometimes it's like, hey, they moved a lot. Let's see how their earnings are going to come out. Are they still profitable here? How much more profitable are they here? What did we price in before that, and so on? I think the silver miners have room to run. If you just look at the SILJ ETF or the SIL ETF, that's one thing. But if you look at, like, there's a lot of junk in there. But if you look at the actual individual mining stocks, they've been moving and they probably have more room to run. What do you think, Kashab?
Absolutely. I think you have to be picky though. So there are a lot of companies that are being promoted where they don't really have an economic deposit, or they have something, but it is so overhyped, so over promoted that you're getting in at a crazy valuation. So if you're looking at a particular stock, let's say, and you're thinking, is this a good buy? Now, the best thing to do is to compare it to something similar and see where the valuations are. So let's say there's a mineable silver deposit in Argentina, which is valued at $5 an ounce silver. And there's one which is also in Argentina, valued at $50 an ounce. And both of them are in, just to pick an example, Salta, which is very mining friendly. Then which do you buy? Well, you buy the cheaper one. But if so, you have to kind of do those comparisons, and it's a little difficult to do. You can also do like for like comparisons between a mine in Argentina and a mine in Canada if you know what you're doing. So you really have to know how to pick your spots. But if you do, then there are a lot of cheap stocks in the silver mining space even after this run up.
No, I agree. So let's end it there. Quick question on the grains. I'll just answer this real fast. What do you think about the situation with the grains? One is they're going to move with energy most of the time. So if we're seeing oil kind of slacking around, lagging around, we're going to wait for that to really put on the table on grains. It seemed like everything was starting to move, and then they just did the thing that they've done for the last 2 years and just kick everybody in the nuts. Basically normal grain trading for most people. So this is going to take some more time. Be very patient here. Don't try to front run this move. Wait for it to continue to make new highs. Right now, I still have a corn half position. We're looking at a half position in soybeans. It is what it is. Just give it time, patience. I think those will start to move this year as well. But once again, you have to wait for these to start making some big moves. And we just haven't seen it yet. So, all right, guys, thanks for hanging out with us. We're going to run. We will be back next week on Friday at 10 a.m. Thanks for joining us on the weekend this time. This was a lot of fun to do these. Always down to do some overtime. Kashab, thank you for joining me on the overtime this weekend. And anything you want to leave the audience with?
I think thanks for having me. And it feels great to do this on a Saturday when it's all quiet. No
Yes.
charts to look at, nothing getting updated. It's so peaceful. So, yeah, thank you for this. And Happy New Year to everyone, and to you too, Jason.
Absolutely. You too, man. Let's have a great 2026, and we will see you guys soon.